Welcome to The Explainer. Today, we're looking at something wild. On August 25th, 2026, Dick's Sporting Goods just absolutely fell off a cliff. We're going to dig into the data today to figure out what on earth triggered this collapse and answer the big question on every investor's mind. Is this massive crash a blaring warning sign to stay away, or are we looking at a brilliant buying opportunity? Let's get right into it. 30%. Just let that sink in for a second. In literally a matter of hours, Dick's suffered its worst single-day stock drop in the company's entire history. We're talking about billions of dollars in market value just wiped out in the blink of an eye. Poof, gone. When a massive established retailer like this faceplants so suddenly, it sends shockwaves through the entire market. It forces us to stop, look under the hood, and figure out what exactly spooked investors so badly.
Which brings us to the central mystery of our explainer today. When a stock gets slashed by nearly a third, it essentially creates this massive fork in the road, right? Down one path, you've got a generational opportunity, a chance to grab a fundamentally strong company at a crazy discount because the market just completely overreacted. But down the other path, you've got a value trap, a stock that looks cheap, but is actually just beginning a long, painful slide toward the drain. To figure out which path Dick's is on, we really need to unpack what happened on that earnings call.
Okay, let's start with the headline numbers that set off the panic. Wall Street was expecting Q2 earnings per share of $3.76. The actual number came in at $3.53. Revenue also missed the mark, coming in at $5.59 billion against expectations of $5.65 billion. Now look, a miss is a miss, and markets obviously hate it when you don't hit the target. But historically, a slight miss like this doesn't usually trigger a historic 30% wipeout. There's more to this story.
The real catalyst for the panic wasn't the Q2 miss itself. It was management taking an absolute axe to their full-year guidance. They slashed their earnings per share forecast from a range of $13.50 to $14.50 all the way down to $11-12. Guys, that is a nearly 20% cut at the midpoint. Revenue expectations were also trimmed down from the $22 billion range. When management essentially gets on the mic and says, hey, the rest of the year is going to be way worse than we thought, investors hit that sell button hard.
But hidden inside this earnings report is a massive plot twist. When you look at the ticker symbol DKS right now, you aren't actually looking at one unified company anymore. You're basically looking at two completely different businesses that are trending in total opposite directions. On one side, you have the core Dick's Sporting Goods business. On the other, you've got the recent mega acquisition, Foot Locker. And let me tell you, understanding the tug-of-war between these two entities is the absolute key to understanding this stock.
Just look at the contrast in these Q2 comparable sales figures, meaning sales from stores that have been open for at least a year. The core Dick's business actually grew by an impressive 4.9%. That outpaces the broader retail industry by nearly 2 full percentage points. They are absolutely winning. But right next door, the acquired Foot Locker business saw a 3.6% decline. So you've got this incredible engine of growth strapped to a massive weight that's just dragging it backward.
Let's break down the good news first, because honestly, it's substantial. The original Dick's business is genuinely firing on all cylinders. They pulled in $485 million in operating income with a super healthy 12.6% operating margin. In fact, their gross margin actually expanded by nearly a full percent. And what's fascinating is what's driving this. It isn't just selling baseball gloves. It's these totally underappreciated digital assets, like their game-changer youth sports app and the Dick's Media Network. Because this core business is so strong, management actually maintained their full-year comp growth forecast of 2.5 to 4% for this segment.
Okay, now for the other half of the story, the problem child. Dick's bought Foot Locker in September of 2025 for $2.4 billion, adding about 2,600 global stores to their footprint. But right now, this acquisition is a mess. In Q2 alone, Foot Locker posted a nearly $32 million operating loss. They're struggling with fewer successful product launches and incredibly heavy promotions across the industry. And the most painful part? Management completely reversed their earlier forecast for profitability here. They now expect Foot Locker to lose between $40 and $80 million for the full year. Ouch.
To kind of humanize this data and understand the reality on the ground, we have to look at what Executive Chairman Ed Stacks said on the earnings call. He pointed out that the market became significantly more promotional as brands scrambled to clear out inventory. But the key distinction he made is right here. This is not a demand issue. People still want to buy sneakers. They still want new, innovative products. The real issue is that the older, quote-unquote, legacy silhouettes, the shoe styles that have been around for a while, have slowed down very quickly, and that's forcing these aggressive markdowns.
Now, given a historic 30% crash and an $80 million projected loss on a massive new acquisition, you'd probably expect the professionals to be running for the hills, right? Well, Wall Street has absolutely not abandoned this stock. Out of 19 analysts, 13 rated a buy, 6 rated a hold, and there are exactly 0, let me repeat that, literally 0 sell ratings. Despite the terrifying drop, the consensus remains a solid, moderate buy.
And all that optimism, it's anchored to a very specific number, $237.25. That is the current average price target from those Wall Street analysts. When you compare that target to where the stock actually landed after the crash, it implies a massive 88% upside. Clearly, institutional money is looking right past the immediate pain of the Foot Locker integration and seeing tremendous latent value waiting to be unlocked.
Let's unpack the bull case driving those huge targets, specifically looking at Wells Fargo's overweight upgrade thesis. They view this as a multi-year recovery story led, believe it or not, by Foot Locker. They think Foot Locker's currently dismal 1% to 2% operating margins can eventually recover to 7 or 8%. How? Better merchandising and their new fast break store remodels, which are rapidly expanding from just 11 pilot stores to over 250. Add to that their view that core DKS is the new star of U.S. sport, and crucially, they see this stock as the absolute cleanest way to bet on an eventual turnaround for Nike products hitting the shelves in spring 2027.
The bulls also have some serious fundamental quantitative metrics on their side. Check out the Guru Focus GF score for DKS. It sits at an incredibly high 90 out of a possible 100. A score of 90 places them in the top decile for both growth and profitability metrics over the long term. Furthermore, their analysis suggests the stock is currently trading roughly 36.8% below its estimated intrinsic value of $283.75. So on paper, the underlying financials still look incredibly robust.
But hold on a second. As an objective explainer, we have to look at the bearish counter indicators too. And man, this one is loud. Despite those high profitability scores, the stock actually triggered a possible value trap, think twice, warning label. Why? Well, the valuation rank is pretty low at 4 out of 10, but the real red flag is the insider activity. Over the past 12 months, company insiders have sold $51.5 million worth of shares, and there has been absolutely 0 insider buying. Nothing. When the folks inside the building aren't buying the dip, it rightfully gives potential investors pause.
So what do you do while you wait to see who's right? Well, for income investors, there is a pretty appealing silver lining here. Because the stock price dropped so drastically, the dividend yield has spiked to 2.75%, which is near a 2-year high. And crucially, the payout ratio is still very conservative at just 38%, meaning the dividend is well protected. Oh, and they've been growing that dividend aggressively at a 35.5% annual rate over the past 3 years. It definitely offers some tangible downside protection while the turnaround plays out.
Synthesizing all of this, we really have to weigh the near-term risks against the long-term bull case. On the risk side, we know this highly promotional environment is going to persist through at least the fourth quarter. We also know the European and Middle Eastern markets for Foot Locker are really challenging right now, and the timeline for fully integrating this massive acquisition remains pretty uncertain. But on the flip side, management is still on track to realize between $100 and $125 million in cost synergies. They have an insanely strong core business, and they are choosing to aggressively invest right through this down cycle rather than retreating.
So how should you interpret this 30% haircut? Honestly, it depends entirely on what kind of investor you are. If you're a value investor with a multi-year horizon, this looks like a highly attractive entry point with some strong downside protection from the dividend. But if you're a growth or momentum investor, the immediate reality is that those near-term margin risks are very real, and the stock could easily chop around or test new lows until the Foot Locker recovery becomes undeniable in the data. And remember, we're just analyzing the data here. This isn't financial advice.
Which leaves us with the ultimate defining question of this entire situation. We know the original DKS business is fantastic. We know the Foot Locker acquisition is currently a heavy anchor, so it literally all boils down to this. Can DKS management successfully integrate and turn around Foot Locker? If you believe they can, then this crash might just be a generational buying opportunity. But if they can't fix those legacy issues, well then that value trap label is going to prove painfully accurate. Thanks for joining me for this explainer, and definitely keep your eyes peeled for those upcoming quarterly numbers.